and thank the Chamber for allowing us to visit today, and also to Steve McFarland of the Better Business Bureau for introducing us to the Chamber, and Mark Laughton, who is a retirement plan consultant, will be working with me, Fred Gawlick, and we're going to cover some of the highlight points of the CARES Act, which was placed into law on March 27th, 2020. And I'm going to cover this next slide with the items that perhaps are going to be involving both participants in plans and participants that have individual retirement accounts, and also some of the responsibilities of the company leadership at the plan level that may affect the involvement of these two items. And the first item I'm going to cover, which is on our next slide, is we're commonly calling it a CRD, and it's a coronavirus related distribution. Okay, so what this is doing, and the next item that I'll cover in conjunction with this, with loans from plans, is going to allow the individual involved in a plan or in an IRA with some opportunities to withdraw funds that they may need or use in conjunction with the concerns that being unemployed, being furloughed, or being reduced in hours may financially put a burden on them or their family as a result of the pandemic with the coronavirus. So what the withdrawal part of it is that an individual that is qualified, and we're going to talk about qualifications for loans and for this CRD in a moment, but they can take money out of their plan or their IRA without any penalty if they're under age 59 and a half. And they can withdraw up to $100,000 from their plan. And this would have to be done between January 1st, 2020 and December 31st of this year. Now, these are only available to a qualified individual. And that means that the individual has to be qualified under certain circumstances. And one of the benefits of a withdrawal is that the individual can actually elect to pay the taxes. So again, there's no penalty of 10% federal for someone under 59 and a half. And there's no state of California penalty, which is 2.5% levied on that withdrawal. And they can pay the taxes on the money they withdraw over a 3-year period of time. So it gives them the opportunity to take, let's say, a $30,000 withdrawal and then have that taxed over the next 3 years, $10,000 per year. So that gives them a significant benefit in reducing their tax exposure on that amount. Also, they can pay it back. So in other words, it's a retirement plan, and the best thing for them to do would be take it out if they need it, use it properly, and then get it back in there for their future retirement needs. Now, on the next slide, we'll talk a little bit about loans. So what loans from a retirement plan, a 401k, a pension plan, a profit sharing, but most commonly a 401k, they can take a loan out of their account up to $100,000 and or 100% of their vested account balance. So what this does is it increases the level of the loan from where it is, where it has been, at $50,000 up to $100,000. They also can skip and delay loan repayments for a year. So they do have some benefits here, and avoid defaults on those loans. So there are some opportunities. And here they are required to pay it back into the plan. And in plan level situations, basically both of these items at the plan level have to be approved by the company, by the sponsor of the plan. So before I get into the qualified individual, hey, Mark, anything else that I should cover here or we should talk about?
Yeah, some other points that I would mention just from, a practical standpoint and what we're seeing with our clients. So here at Quintus, we manage a little over 350 retirement plans for different companies and organizations throughout the surrounding counties. And in that, what we're seeing, especially here with the loans, is that it is just that. It's a loan. So you do have to pay it back over a period of time. And so with these loans, they're considered a general purpose loan. So even if you can delay them for a year or until the end of 2020, you do have to pay them back during that 5-year period. So as an example, if you have somebody that takes out their entire account balance and say that that's maybe 75,000 or the full 100,000, they do need to have the ability to be able to pay that back each period. Or else it is deemed a distribution, and we'll talk about some of the ramifications that go with that. So if you think about it, if somebody took out $100,000 and they have to pay it back over a 5-year period, you could be talking about per pay period payments. If somebody gets paid twice a month, you could be talking about payments north of $1,000. So that is, for most people, something that might not be appropriate or something that they can pay. So that's one of the things that we're reminding our clients. And when we do get a loan request that is of a very high dollar amount, or it's a coronavirus related loan, we do review it with the sponsor to make sure that they discuss it again with the employee to make sure that they do understand that it does need to be paid back, even if it's delayed for the remainder of 2020. So I just wanted to talk about an example there.
Yeah, that's great. Now on the next slide, we'll talk about the qualifications and the eligibility for the higher loan limit and the CRD is available to a qualified individual. Okay, what's a qualified individual? It's actually someone that is diagnosed with the coronavirus, or their spouse or dependent is diagnosed with the coronavirus, and also who is experiencing, or again is experiencing adverse financial consequences due to their furlough, their quarantine, reduction in hours, inability to work due to lack of childcare, and those other items that are really on this screen here. And here's the biggest benefit to companies that allow for the increase in the withdrawal and the loans is that it's a participant certification that's required. So the company does not have the responsibility to investigate and be sure they're all qualified. It's basically the individual self-certifying. Most other things in the past with withdrawals from plans, especially the individual company, the fiduciaries at that company are required to handle that. So you, for an IRA, you'd be doing it on your own with your custodian, and with the plan, you'd be doing it through your company and the responsibilities of working with the proper channels to deal with the individual company that's handling the investments of those plans. Okay, so from here, I think we're going to move into a lot of the items that Mark will cover and deal with the plans and some of the situations that are available and changes that are taking place as a result of the CARES Act.
Great. Yeah, thanks, Fred. So what we'll transition into are RMDs, as they're commonly known, or required minimum distributions. So these are where somebody meets a certain age. So it used to be age 70 and a half. And then with the Secure Act, which was actually passed in December of 2019, they pushed that age to age 72. So it's when the IRS says, hey, you've got that tax benefit for long enough, you know, it's time for us to collect our tax dollars on your retirement accounts. So in that, with that required minimum distribution for those folks that had already turned 70 and a half, or now if they turn, call it 72 here in the future, this pertains to those that will not have to take out their RMD. And the reason that they're suspending RMDs is similar to why they did it in 2008. So an RMD is calculated based on December 31st of the prior year. And so you might ask yourself, well, what does that have to do and why does that have an impact on where we're currently at? Well, as you know, the market has been very volatile, and particularly it has been in a decline since the end of last year. So you had a calculation that was based on a higher value at 12/31, and now the markets, as you know, have come down this year to where they're currently at. So if somebody does need to liquidate their account, they're selling out at a loss. So with that, what they've done here is they've provided some relief for those folks that have taken their RMD either already in 2020 or still need to, and said, hey, you don't need to take that RMD. Now, for those that did it in 2019, those cannot be corrected or reversed. But for those, as I said, that were done earlier this year, somebody can go back and correct those. And Fred, I don't know if you want to add anything in here. I know that this is something with your individual clients that you might be talking through.
Yeah, basically it's the individual sometimes at 70 and a half and beyond, and 72 now. Sometimes they really don't want to take those RMDs. So here's an opportunity for them to delay it.
Yeah.
Avoid it for a year.
Perfect. So defined benefit plans, these are either what they are, defined benefit plans, or what some people might have as a cash balance plan. So this is typically a plan in addition to a 401k plan. So a company or organization might have a 401k plan, and then in addition to that, they have a defined benefit plan. So think about probably your parents or grandparents and their pension that they get for working at a company for a long period of time. Or as an example, my mom's a school teacher, so she gets a pension from the school or from the state when she goes to retire. So there are still organizations and companies that do sponsor defined benefit or cash balance plans. And this CARES Act has also provided relief for the contributions that they need to make. So essentially what they've done is they've just pushed out the required contributions so for the contributions for 2020 and also for 2019 can be pushed to January 1st of 2020. So again, some relief on the timing of the contributions that need to be made by the company. Important thing to remember here, that even though those contribution deadlines are delayed, those companies are accruing interest on their plan based on that accrued interest rate. So that is something to keep in mind for those sponsors. Also, too, from a budgeting standpoint, they will have all of those contributions due all at one time. So if they're used to making quarterly contributions to the plan and they're delaying that, they just need to know that come January 1, 2021, it's all going to come due. So those are things to keep in mind as people look at their defined benefit or cash balance plans, as they might also be considering freezing them or some other options as well. So again, the relief here that they're offering, extending some of the deadlines, also too, easing some things as far as PBGC premiums. Again, extending some of the due dates. And then they do have an exceptions list that does apply. Again, we'll go over this somewhat quickly just because not a lot of organizations or companies still sponsor defined benefit plans. It would be great if they did, but those are commitments that a lot of companies and organizations have gone away from. So what about notifications? So notifications, if people do make changes with the CARES Act, So technically, a plan sponsor does not need to provide notice that they are adding the coronavirus-related distributions or coronavirus-related loans. We do think and we do feel for our clients that it's best practice to provide notification to the clients and to the employees to let them know that that is available to their employees if the employer has decided to implement it. Fred made the comment earlier, which is exactly right, which is the employer does have full discretion if they want to offer coronavirus-related distributions, coronavirus-related loans, if they want to offer delayed payments of those loans, which actually is a separate feature that they need to enact. They can do one or the other or both. So those are independent situations, and they will have to make amendments to their plan document, but those amendments will not need to be done until the end of 2022. So they are giving some time as to when that can be done. So as an example, the way this works in the real world is, as an example, we had a client yesterday. So they finally decided to adopt coronavirus-related distributions. They decided not to implement coronavirus-related loans. So with the CRDs, right, the distributions, they went ahead and did that, and were able to quickly do that with some paperwork and get it back to the record keeper, right? Think about that company that provides you your quarterly statements or that you go on the website. So different names like Fidelity or Voya or John Hancock, different providers, again, that you log into your participant account or that you upload your contributions each payroll period if you're administering the plan. So you just do some paperwork with them, and then you can address the amendment that needs to be made, and it can be done anytime before the end of 2022.
You know, it's interesting. I'm going to comment on this part of it with the employer setting up and approving this. It's pretty much a document they sign off on now, or something they would sign off on. And a lot of what I think Mark and I are covering may really start hitting a little more downstream, because individuals aren't that much aware of this. The media hasn't really publicized it much, but when it starts being knowledgeable by the individuals, people knowing about it, they may be coming to their employer and asking for, hey, can I take out a CRD, or can I take an enhanced loan? So it'd be something that may start hitting a little bit more downstream.
Yeah, and Fred, you're exactly right. What we've seen from our clients is a lot of them, we've had a lot of calls and Zoom meetings and interactions with our clients and talking about this and consulting with them. And for a lot of them, what they've decided to do, instead of be proactive and add these on their own with the idea that there will be a demand, is that they're waiting until they do start to see a demand, which I also think is actually a good approach to see if there is indeed a demand for those folks looking to access their retirement funds.
Right.
So some different approaches as far as how employers are going about either adding or not adding these features. So again, talking about some of the different deadlines and how those have been extended. This goes over a lot of the same. There's still more to come, and as far as clarification from the Department of Labor and the IRS regarding certain deadlines. So we do continue to be updated and get reports as far as dates. Let's talk about some of the other coronavirus-related things to keep in mind. So a normal hardship distribution. So a normal hardship distribution, if a plan already does have hardships as part of their plan document, those are typically can be for safe harbor reasons, which follow a strict list of guidelines as to why somebody can take a hardship out of a plan. And this, of course, provides access for that participant to the assets in the plan. In normal distribution, so we have had a few clients and they say, well, Mark, what's the difference between this coronavirus related thing and a regular distribution? We already have distributions as part of our plan. We don't need to add this. And they're not understanding some of the benefits of a coronavirus related distribution. So as Fred talked about earlier, it's waiving that 10% early withdrawal penalty. So that's the federal penalty. And then here in our beautiful state of California, they want their cut too. So in a normal distribution, if somebody is below the age of 59 and a half, that's that additional 2.5%. So 12.5% that they're not having to pay if they go the route of using the coronavirus related distribution versus a normal hardship distribution. So Some key factors to keep in mind. Also, too, as Fred gave that really good example of if somebody took out a $30,000 hardship with a coronavirus-related distribution, they can pay the tax over 3 years, right? So 10,000, 10,000, and 10,000. Where if they take out a normal hardship distribution, they're going to have to pay taxes all in 1 year. So again, some big differences between a regular hardship and a coronavirus related distribution. Fred, anything you want to add on there?
No, that covers it as we see it right now. Yeah, definitely.
Okay. And there was some things on here about FEMA and declared disaster. So when there is a national disaster, then or a natural disaster, then people can have access to their money. So we saw that back during Hurricane Katrina. We saw it during the fires up north in the Napa area. So again, that's a normal hardship distribution as opposed to what we're seeing now with the coronavirus related distribution. So partial plan termination. So this is something that some employers are facing with their reduced workforce. So when they are laying off and when they are furloughing employees, they do need to keep in consideration that they might be triggering what the IRS calls a partial plan termination. So this is if there are 20% or more of the workforce is reduced within a period of time, then technically there could be a plan termination. So, and you'll notice in there, it does say rebuttable. So it does mean that you can make your case to the IRS that, hey, we did reduce our workforce, maybe it was in excess of 20%, but this is formally looking at it, that this is a potential issue for some employers, again, that are reducing their workforce. This is based on facts and circumstance. So we do think that the IRS will be more lenient in the sense of knowing that we're going through this pandemic. But this is an issue that technically, by the book, will come into play. Now, one of the things that might be interesting for some employers and that they might want to pay attention to is how they use forfeitures and what their process is and how they're forcing money out of the plan. So let's say that I'm part of a plan, I'm an employee, and I get laid off, okay? And they go ahead and they terminate me. I have my balance that I've put into the plan, right? I've contributed out of my paycheck, so that's 100% vested. Then you have the portion of the plan that's been put in by the employer, right? So maybe they matched my contribution 50 cents on the dollar up to 6% of pay. But that is tied to a vesting schedule. So that vesting schedule, let's say, is 5 years. So I'm 20% vested each year over that 5-year period. Well, if I get terminated in the 3rd year, I'm not fully vested in that contribution. So if they were to pay me out, then they would keep that forfeiture amount with the plan. So in the case of a partial plan termination, the employees are immediately vested on their full balance regardless of their time of service with the employer or with the organization. So that's a unique circumstance to be aware of. But again, there are some plans that they have laid off or furloughed a significant amount of their workforce. Again, we think the IRS is going to be lenient or understanding as these situations arise in the coming years.
Yeah,
go ahead, Fred.
Yeah, these are some of those issues and situations where at the employer level, there's so much going on, especially now with just running the business in these trying times, that a lot of these details are of concern based upon facts and circumstances, and they're hard to deal with when they occur.
Right. And there are, the industry in general, the retirement plan industry and financial services industry is lobbying with Congress to try to make it clear that if somebody was furloughed due to COVID-19, that's not counted as part of the formula for the 20%. So that's something that we're hoping we get more clarification on here in the coming weeks or months. The definition of compensation. So this is always an issue in some cases when you have the way that a company thinks that their plan works or the way that they think that it operates versus how the plan document says it's supposed to operate. So as an example, and this is a normal situation, you might have a company that pays a base wage and then they pay, bonuses or commissions or things like that that are in addition to their base wage. Well, if there's a company contribution or a company match, the company might say, well, we only want to match the base compensation, right? So if somebody makes $50,000 a year as their base compensation, if they're matching 4%, 4% of 50,000 would be $2,000. So that's the match that they intended to make. But the plan document might say, we're including all these different forms of compensation. So if that person made another $30,000 as a bonus, they would need to match that additional $30,000 or $1,200. So it's very important to understand the definition of compensation and make sure that that's in line with the plan document. So that's what we're seeing here as well with some of the benefits that employees are now eligible for as part of the Family's First Coronavirus Response Act, or the FFCRA. So there are some additional wages that employees do have access to, and it's important to make sure that those align with what's in the plan document. So again, some other smaller issues that could turn into bigger issues if an employer is not aware of how their plan document reads. So reducing contributions, right? So we've had a lot of our clients, a lot of employers that have reached out and said, hey, we're trying to plan, we're already experiencing financial difficulty, or we think that in the coming months we're going to start to face some financial challenges. Can we reduce or eliminate our company contribution? So whether that's a company matching contribution or it's a profit sharing contribution, whatever it might be, can they eliminate it? And the answer is, it depends. So with that, if it's a discretionary contribution, there's no legal requirement that they need to amend the plan. So if somebody says, hey, our match is discretionary, it's 50 cents on the dollar up to 6% of pay. Our intent is to make that match, but it is discretionary, so they can stop that at any time. So that you don't need to make any changes. Now, if it's hard coded into the document, so you could have that same matching formula, but they wrote it right into the plan document. In that case, you would need to amend the plan, and you would need to provide a notice to employees to let them know that you're no longer going to be making that matching contribution. A very popular type of company contribution is called a safe harbor contribution. And so somebody might have a safe harbor match, or what's called a safe harbor non-elective, where they might be doing 3 or 4% as far as the company contribution. And in that, somebody can reduce, or not reduce, but eliminate that contribution, but they do need to provide notice, and they do need to have, as part of their plan document, the ability to get out of that match. And so that's part of the employee notice, or the safe harbor notice, that's given out once a year. So with our clients, we do include that so that they have that flexibility, that they can eliminate that match at any time. They do have to give a 30-day notice. So we have provided that to a number of our clients. They give out the notice, as an example, on May 1st. And then as of June 1, they will no longer be making a safe harbor contribution for the remainder of the year. Now, they do have to wait until the next year before they can reinstitute a safe harbor match, as an example, or a safe harbor contribution. One of the things to keep in mind is discrimination testing. So a safe harbor type of contribution, when you follow that formula, you do not have to test for discrimination between highly compensated employees or owners and non-highly compensated employees or non-owners. So that is something where, that's why a lot of small businesses use a safe harbor formula, is to avoid that discrimination testing that they would have to do if they didn't otherwise use safe harbor. So that is, as I say, a big deal and something to consider. Again, people should consult with their providers and their consultants on whether that might make sense or not, or how they should advise those highly compensated employees to maybe cease their contributions for the remainder of the year. So again, things to consider regarding reducing or getting rid of company contributions. Fred, anything you want to add there?
No, in summary, a little bit about what you covered in the last couple of slides is the importance of the practice of the plan, what is actually going on, and the employer wants to go on, matches what the document is allowing and says in print and from a legal standpoint. I'd also encourage anyone that might listen and watch this presentation to think about things and pick up the phone, call the individuals that are advising you, or call someone like Mark, ask the question, and perhaps get a quick answer to a situation. So.
Yeah, absolutely. Yeah, you're paying your providers, and your employees are paying providers out of their account balances. So, pick up the phone, proactively reach out to those folks, and make sure that how you're administering your plan on a regular basis aligns with how the plan document has been drawn up. Again, those are the type of things that under audit, if somebody is audited by the DOL or the IRS, or just performing a self-audit, those are things that can come up and say, okay, we've been understanding it one way when our plan document does not align with that. So again, just being aware of those things, and also to some of these changes here with the CARES Act. So that's what Fred and I prepared for you today. We thank all of you for listening and for watching. Brittany, do you have any final words before we wrap up?
I was muted, sorry. I don't think I have any questions in the chat box just yet, but if you both wouldn't mind just giving us like what you think in your opinion are the top 3 takeaways for business owners to be aware of, like the top 3 important things that they really need to be watching right now.
Well, okay, let me start, and I'll address a little bit of the individuals in plans and individuals with their IRAs. And, certainly with us being quarantined for such a long period of time, it's a good time to assess a financial situation in your own household, yourself, with your partners, and really look at your plans and check things out. At the individual level, check your beneficiaries on your accounts. Make sure they're up to date. Review your estate plan. Review how your money is put into your plans. And, ask yourself the question of what do you really want this money to do now and in the future? And if you take any money out of it now, are you sure it's a good decision? So individuals, I would encourage you to do things along those lines. And as business owners, certainly you're participating in the plan. So be sure you're dealing with your own account properly. And Mark?
Yeah, I would add there, I know Fred focused on the employees and individuals, and he's absolutely right. I think one of the things that we're seeing and that we'd like to be seeing is an emphasis on financial wellness. So employers really helping their employees with being more financially well. And so with that, doing that through tools and resources that are probably already provided to them or can be provided, in helping them really understand everything in their finances, from short-term things like budgeting, cash management, debt management, all the way through to their long-term finances and how they're addressing preparing for the future. So what we've seen here in this situation is, unfortunately, a lot of people don't have, a short-term nest egg or, an emergency fund. And so with that, when they get furloughed or lose their job or have a reduction in hours, it's putting a lot of stress on their finances and unfortunately also on themselves and their families. And so what it reinforces to us is we need to continue to promote education, and we need employers to continue to promote education to help people understand how to use their dollars most effectively, and in making sure that they're trying to build that short-term savings so that, when a rainy day or a pandemic comes along, that they're prepared to have money on hand for, call it 3 to 6 months of expenses. So again, I just encourage employers to provide as much education as you can through your vendors. So, that could be your advisors, your record keepers, your third-party administrators. Please reach out to those folks. You're paying them, so please have them work with you and your employees to make them more financially well.
Thank you. Thank you all very much. Thank you, Mark. Thank you, Fred. Thank you, Steve. This was extremely informative. I have a lot of homework to do, as I'm sure many other people that watch this will. So thank you for spending the time with us. We really, truly appreciate it. And we look forward to having you next time.
Thank you.
All right.
All right. Have a great day, everyone. Have a nice weekend.
Okay.
Thanks. You too.